Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. One past guest includes Andy Gerchak of All City Adjusting, talking about his role as a public adjuster fighting for every dollar you deserve on an insurance claim. Andy's helped a number of different clients of ours, and his podcast dives into the details of how a loss claim works and how he can fight on your behalf as an investor. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Listen, Wayne, your asset management team will know undoubtedly how hard it is to line up contractors to get a make-ready done in a reasonable amount of time after a tenant leaves a property. Contractors are busy, the work seems to drag on forever, and all that leads to lost rental income for companies like CREI. At Keyrenter, we line up our dedicated vendors so that turns can happen super quickly and we get more money back into the pockets of our owners. That's why no matter what rental you have, single-family homes, condos, townhomes, we have the property management solutions that you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. I'm excited for today's guest. Wayne is the founder and lead sponsor of CREI Partners, which manages over $60 million in commercial real estate assets across Texas, Louisiana, and Alabama. Wayne helps busy professionals build generational wealth through passive investments in apartment communities and storage developments. He's a former Marine Corps general, and Wayne brings over 16 years of experience from a Fortune 125 real estate firm and now focuses full-time on creating high-yield returns while giving back to local communities. The man's an Eagle Scout, was a corporal in the Marines, and has lived a few lives in the business world. As you're going to hear, visit CREIPartners.com for more information. Wayne Courreges, welcome to the show.
Thank you, Matt. How are you doing?
I'm great. How are you doing?
I'm good. I'm excited to
You look good.
talk real estate.
That's what's important. I don't know how many people actually watch this on YouTube. So maybe it's more important to have a good voice. I don't know.
Yeah. I think I have like the afternoon shadow probably going on. I have to shave every day. So anyway.
If I don't, my kids harass me. They don't let me get close. Get too much prickly. Yeah. Cool. It's great to have you on the show. I am super curious about the general business model. I mean, I understand CREI Partners does general syndications of commercial assets. Mm-hmm. I want to get into your history, but before we get into your history, tell us CREI Partners, like what's the general asset class that you guys work on? What are the specifics of that commercial asset class that you work on?
Yeah. So 80% of our portfolio approximately is multifamily, 100 to 150 plus units, but 100 and 150 is our strike zone, 1980 or newer, primarily in the Texas Triangle, Houston, San Antonio. If I dived in a little deeper on our markets there. Then we've got about 20% or so that's more development. We've done a RV boat business storage, all enclosed 20 by 50 space units. We're in the process of developing a multifamily, 150 unit multifamily.
Beautiful.
Class A property here in Bryan. We're doing a hotel and an office retail. It's all part of this mixed use, but we're the lead developer on it.
Beautiful.
We've done so primarily multifamily with some other alternative asset classes.
On the stuff that you're developing, you don't consider yourself a merchant developer, though. You're a build and hold.
Yeah, it's typically 5 to 7 years on all of our properties.
Yeah. Excellent. Let's go back now because I understand a little bit about what's going on. You're an Eagle Scout.
Yes.
You're a Marine Corps corporal.
Not as lean, not as mean, but still Marine. Yes.
Thank you for your service.
Thank you.
And you've lived like 3 separate lives. You've got 3 degrees. You've done a stint in commercial real estate with CBRE, and then you jumped out and went on your own with CREI.
Yeah. And that stint was 16 years. So it was a big chunk of my.
That's a whole life. That's a whole life right there. That's a whole life. What's the biggest difference about being an entrepreneur and doing a 16-year stint at CBRE?
So at CBRE, I've really had a great, I mean, I would say looking back, I had a, I liked the team, I liked the atmosphere. I did like that every few years I was able to go to a different city. And so like we started off in Washington, D.C. as we're out of the Marine Corps. So I went to the Marine Corps 2003, 2007. CBRE was hiring junior military officer type people where they already had the leadership skills. They just needed to teach property management or commercial estate. So joined CBRE in June of 2007 and, took on more responsibility there, went to Houston, got some really great opportunities to manage some trophy properties. Beautiful. When I say trophy, like large, 40 to 50 story plus office buildings, which was a highlight of my career. I was in my 20s managing these incredible buildings. And then I went to Austin, was more of a director role there. So a lot of office retail reported to me. I reported up to a managing director, but I was one of the associate directors there. Then went back to Houston. So I did like sort of that, I won't say military type way, but it's sort of like I was able to go different places for promotion. I was able to, I treated it sort of like a duty station in a way. Like, hey, I can go here, grow my experience, grow a portfolio. And they took care of me. I always had good leadership. Part of the process would work CBRE, and this is any company, even in my company, you have policies and procedures. You want to have systems and processes in place, no matter what size of company you're in. So for me, going into the corporate world, I had to learn how they cook their hamburgers, do what, like the way they do their systems, right? Whether you're McDonald's or wherever. Well, that entrepreneurial spirit sort of dies because you're following SOP and the procedures. Well, it wasn't until I went back for my MBA that I'm like, oh, dang, I have this entrepreneurial. I mean, I had this huge entrepreneurial passion early in life. And so it rejuvenated me through my MBA program. And that's when I started. Part of my MBA was creating CREI Partners and doing the real estate investment aspect. And so I would say the stress is different. With the W-2, you're going to have different stresses that are not really related on cash flow because you depend on your employer to pay you every 2 weeks. So I wasn't really stressing about my pay every 2 weeks, but I was stressed as when properties were selling or things were happening. Like, hey, does this mean I still have a job or do I need to look at another company? So on the entrepreneurial side, it's a different. Now I've got multiple team members. I'm feeding myself and multiple people. And so I've got to be more in tuned and thoughtful about, future properties we purchase. How does it look like, not only from an investment side, but also a cash flow side. So it's just a different way of looking at things.
Is there a way to encourage entrepreneurship within your organization? I mean, I get it. You want SOPs. Because you don't want people running rogue and making decisions. But essentially what you're trying to do is say to a colleague, an employee, make the decision that I would make when I'm not here. I mean, that's what a procedure is, right? I mean, if it was just you in an organization, you wouldn't need procedures because you would do it right every time because you're the judge of the right. So what you're trying to do is get them to make your decision. I really hesitate that. I really struggle with that in our businesses. Like, I want people to make the right decision, but God, I do not want to make a process and a procedure for everything because it just kills. First of all, it kills creativity and outside of the box thinking and there's lots of solutions that don't fit in an SOP, but they're the right solution for that moment. And then when you give people, bullet points of how to proceed, they just stop questioning whether this is the right way. And you put something on paper in 2020, you don't know if it's the right thing to do in 2025. What are your thoughts about that?
I think it's a blend. It depends on where you sit. Are you on the property management side or are you on the ownership side? So for me on the ownership side, we are definitely very entrepreneurial. Every property we buy is its own business. So when we underwrite a deal, we look at it from a revenue expense side. There is gray area in how we interpret and how we can run a business plan. But from an accounting, like if you're on the accounting side, you need to follow policies and procedures. Like there are rules, gap rules, et cetera, you need to follow.
Yeah.
And then
True.
we always, as an owner, majority of our properties are managed by third-party management companies.
Yeah.
So, the reporting.
You certainly want them to have procedures.
Right. Well, you would, because, hey, if a tenant doesn't pay on the first of the month, there's an eviction process, there's a notice eviction, there's late fees. When I tour a property, I don't want to see a bunch of, barbecue grills on the patios, et cetera. Like, there's got to be procedures, because there's consistency. And I even will say, like, one of our properties that we have under contract right now, I toured that property
to sell or to buy.
To buy.
Yeah.
We have it under contract to buy. But that property is immaculate. I open up a closet, their maintenance closet. I mean, it's organized, clean. I'm like, when we close on this deal, which will close in September, like, this is the new standard. This is what we get all the property management from other, like, hey, let's come up with this type of standard, because, it provides that consistency throughout. Now, from an entrepreneurial standpoint, I think from a property management side or operations, giving them latitude on customer service and the ability to have some type of hospitality mindset is important. So when you look at, like, the Ritz-Carltons and these, other high-end hotels, the staff, behind the desk or the, housekeeping, et cetera, they're trained through customer service trainings to provide an incredible service and experience. And I think in real estate, people forget about the experience. I go to a lot of these conferences. No one's really talking about hospitality or experience, or in a multifamily conference. So I'm like, okay, well, that will differentiate us, because that helps our retention. That helps, bring in, more value with higher occupancy and et cetera. So it just depends on where you are on the capital stack. I mean, our company too is small and nimble, but when you're a massive 150 Fortune 150 company, there's a lot of
you have a lot of people
out there that can do some bad stuff, and then you're in lawsuits and stuff. So you've got to be. Just depends on the size and what you're actually doing.
Yeah. So 80% of your portfolio is 100 to 150 units in growth markets. Yeah. A lot of our clients, they've historically loved single family residential units. They, it'd be common for somebody to say, well, people always need a roof over their head, and, they like residential. You're in that category already. Why would you encourage somebody to jump from a single family portfolio into a multifamily portfolio? Whether they're going to buy, the average person is not going to buy 150 units on their own, but whether they buy a small multifamily on their own, or jump in as a limited partner in one of CREI's deals.
I think I started in single family when I was in the Marine Corps. I bought my first rental when I was stationed in 29 Palms. I was 19. And, when the property is leased with good residents, life is good. You get that check every month. Maybe you have a third-party management company you're paying, but it's when the property gets destroyed, or when that person leaves and then it takes 3 months to release. And so that's negative. You don't have that cash flow. Yeah. HVAC goes out, even if you have a home warranty. Those home warranty companies, the guy in the white van, not marked, showing up, it's sketchy. They don't do a good job. And then you always have, it's like, you just buy a warranty, plan. And it's like, no.
I hate those warranty plans.
And I've done it time and time again, when I buy my personal residence, and I have them over, like, God, why did I get the guy that has to drive 2 hours, from his, like, there's a reason why he's driving to drive 2 hours.
He's accepting home warranty
to do the work.
Yeah.
Yeah. For, $100, deductible or whatever. So those that are in single family, look, being in real estate is fantastic. I think it's good. But what people fail to realize is just the amount of work and really the profit margins in single family. I just didn't see it being there, and the amount of work.
Yeah.
So think about roofs instead of units. So if those listening, and you may have like 10 homes, I'm just throwing a number, I have no idea. Say 10 homes. Well, that's 10 roofs. Well, I can have 40 homes or 30 homes in one building with one roof.
Yeah.
And multiple roofs, so maybe 3 or 4. So, if I times that by 4 buildings at 30 units each. That's 120 units. So I can have four roofs at 120 units. I'm just throwing numbers out versus like 10 roofs for 10 or 120. So it's like different roofs, different HVACs, different plumbing systems, water heaters. I got one boiler servicing 150 units.
Yeah.
If that boiler goes down, well, I've got a lot of cash flow to cover that expense because I got a lot of units. Look at the break-even occupancy too, like, to pay your debt, and this is me speaking more for like an active investor. When I say active, those who are going to source, find deals, operate deals, they're finding debt potentially, hopefully, that will have like a strong cash flow property so that they're, maybe a 75% break even. So 75% of the property has to be occupied to break even. So 25% of the property, in essence, can be vacant and I can still pay my bills and my mortgage.
Yeah.
So I would say the risk standpoint. Now, I think what I get a lot of my investors from, Matt, is actually they started with single family. They absolutely hate dealing with tenants. They hate dealing with toilets and they hate dealing with termites, and it's just an example, just the headaches, the 2 a.m. calls, whatever, just stupidity. So then they start like, okay, well, there's an easier way. And so syndication, you mentioned syndication, but I think some people don't know what syndication is.
Sure.
So just the basics of it, it's pretty much pulling your money, other people's money together to buy a property or buy an investment or a baseball club. It can be anything, but it's pulling money together to buy something you couldn't maybe do on your own or wouldn't want to do because you don't want to have all your money in one basket. So syndication allows you to, pull money, reduce that exposure. So instead of that one single family home that you now bought, maybe you put 100,000 down. Well, maybe you can go into 2 multifamily syndications or a retail office syndication, whatever your comfort is. So there's that diversification as well. That I get a lot of single family investors who are like, they bought into the dream, but then they realize like this dream is another job. And so I'm providing is like not a job. Like you're still in real estate, but you don't have to do any work because we do all.
But also the joys of a syndication are that or one of the joys of a syndication is that your exposure is limited to the capital outlay that you put in. So you're not on the debt. Nobody's ever going to come back to you. If the project fails, you've lost your money, but you certainly haven't gone bankrupt from it. Hopefully you're not, nobody's coming after you for a personal guarantee on the note and hounding you for the next bunch of years. But that raises a good question. When you're thinking, when one of our investors is thinking about potentially joining a syndication, being a limited partner in a deal, what do you think they should be looking at in terms of the general partnership? Like what criteria do you think is important to be reviewing for a general partnership before you plunk down $50,000 or $100,000 in a deal?
Yeah, so there's a lot to that, and definitely we'll dive into it. I think first and foremost, having some type of relationship with that person or that company prior to the deal coming to you, and that may be joining their email list, that may be joining, doing a meetup or whatever, but just seeing like how they are as a person, because most of us, especially those that are listening to this podcast, because it shows that they're interested in learning, they're probably sophisticated enough to judge good character. And or at least have like the spider senses, like something's not right. Right. And so I would say at first, like if it just doesn't seem like a good fit, just off of personality or trust, just as basic as that, right, is just making sure, because in essence, like they're running the property for the next 5 years while you're sitting on the passive. So you got to like the person, right? Mm-hmm. I mean, in essence, so that's step one. Step two is general partners, similar to like when they bring in a bunch and let's talk about general partners, limited partners. So limited partners is where people sit if they're passively investing. They invest $50,000. They're limited to that investment and that exposure of that risk, but they're still owners in that asset. And then you have general partners who are the ones who are signing on the debt, ones who have found the deal, put the deposit, earnest deposit, running the business plan. So those are two buckets. So typically the general partners, if they're buying an asset, say a large 150 unit, they will be multiple team members within that general partnership, because not one person could do it all, meaning maybe that one person didn't have the net worth, liquidity, the experience, the desire, or the time, et cetera, to run the asset. So you want to know, as a limited partner, those listening who may get into passively investing, is like, who really is the decision maker? Because there could be a lot of, dust of like the multiple general partners, but who's really that experienced one?
How would you even find that out? I mean, there's one guy that has balance sheet strength, as you suggest, the liquidity, the net worth. There's one guy that only knows how to manage property managers and make sure that the asset is performing. But how would you actually get to the crux of who the real decision maker is in a general partnership?
So they should, you should ask, right? They should tell you. But when you sign the private placement memorandum, so mind you, like when you passively invest, you're buying a security into a business or an asset, right? So it's governed by the Security Exchange Commission. So the SEC, we do a private placement memorandum, which has the subscription agreements, company operating agreements. Those documents that are signed typically is signed by one person on the general partner, and that person's listed as a manager. That manager is typically the ultimate decision maker. So that's one way to check and balance. There's no like, it's not bad if this person is not the decision maker, but they're part of the general partner. That's normal. Like that's just part of teamwork. It's like the tight end's not going to be the quarterback because he's a tight end. You need your team.
Yeah.
But so they're going to be very transparent, like, hey, this person. But another way to, cross-check that is typically you could see who's signing those operating company agreements as the manager. Just one way to look at it.
Yeah. On the asset management side, so you guys, if anybody wants to check out CREIPartners.com, you'll see that they are generally targeting, correct me if I'm wrong, 8 to 10% cash on cash returns with a 15% IRR. Is that right?
Yeah, 15% IRR is our minimum. We typically would want to see, 18, 20%. But for us to even get excited about a deal, we want to see a 15 IRR.
Yeah, but that's a great 8 to 10% cash on cash from an LP perspective. Great return, doubling your money every 7 or 8 years. I mean, that's a solid play. What are you guys doing that's different, or how are you managing the asset to create that performance?
Yeah, good question. On the returns, though, we typically see, so that when we talk about 8 to 10% on the preferred return, year one could be 4%, but that other 4% could be accrued, right? And so when you look at over a 5-year period in the exit, on a 2x multiple, we typically would see a 20% average annual return. That's the cash flow and the exit. So one of the things that I have had to do as a company is ensure we bring in the right talent to execute on the business plan.
Yeah.
So the first few years of having my company, like I was the asset manager, I was the investor relations person, I was and that was okay.
Typical entrepreneur.
Yeah, and that was okay, Matt, because I had many years of experience doing that with CBRE. So it wasn't like this, I had to learn this and all. Like I was already doing it, and I was just doing it for my investors and myself, which was good. But once we started building out this portfolio and going back to that hospitality and that experience, for me, it was important to hire a full-time investor relations person and also someone who could help coordinate my schedule and time and all. And so that was a critical hire for us. And more so outside my, emails and stuff like that, the bulk of her job is focusing on investor relations. And that investor relations is that experience, hospitality, as simple as like, you invest with us, Matt, on your birthday, we will text you, happy birthday. I hope you're doing well. Like we have a relationship. And it's like so many groups, you invest and you may get that monthly update, but there's no real relationship, long-term partnership.
Yeah.
So that was a strategic hire for me is hiring that person who can help guide people through our investor portal and the subscription documents and answer questions. Obviously, I'm there too, and I'm happy to help, but it just provides that extra level of experience. And then as we started growing a little further, I was like, okay, well, now it's time to hire a senior portfolio manager, which is also another term for an asset manager. And not someone who is learning, but someone who's already been doing it and who can hit the ground running day one.
Yeah.
What I'm saying in all this is that we've invested in the company. Like we're not just squeezing all the profits and me going to Hawaii and just enjoying a long vacation. It's like, no, we put it back in the business and we're growing in a way that supports the actual growth that, we're going. If we buy all these properties and we can't asset manage because it's all on me, then, the property is not going to do well. So that's what we'll do. Now, once they hit about 10 properties, it's time to hire another asset manager.
Sure.
So, and then as I mentioned, everything is third party managed. So they're not in the weeds of all those things. So that's how we operate. The annual budget, similar to any business that think of all this as businesses, like each property is a business. We have an annual budget and we check in. That's our North Star. And every quarter, I get a report showing, where we're at. Every month we get financial reports. And then I also get daily KPI emails about everything. So I'm tapped into where we are financially, what our occupancy is like, what our delinquency is like, what repair funds, what invoices are outstanding. Like all this is, what I look at.
But the asset manager would see, I mean, to your point about a boiler for 100 units or whatever, that the boiler is down and you've got 100 upset apartment units. We have to make a decision about whether we're going to repair or replace the boiler. And the asset manager may be involved with the property management company to determine whether this is the first time or fifth time that this boiler's gone down, what's the age of the boiler, and whether we've got the funds right now to actually do the CapEx required to replace it, or rather just repair it one more time and see if it holds this time or whatever.
That's
By the second bid, third bid. Is that right?
So spot on. And making the decision, and this is where like HVAC units, the easy answer is like, we'll just replace the HVAC units. Like,
Always.
Let's repair it.
Hold on.
So we don't need to just replace it. So
yeah. That was an $800 blower motor. I'm not sure we needed a $5,000.
Yeah, we don't need to replace. So having an asset manager who questions and pushes back, and honestly, having a management company that thinks like that is hard.
Yeah,
that is so hard. But if you can find, in your property management at Keyrenter, but thinking like an owner and finding talent and people to join the team that think like an owner, that's what separates. Because I don't want to be in the weeds in property management. Yeah. I'm happy to be strategic asset management with my team and all that. But I will do it if the property management company can't think like an owner and make
the challenge. Decisions. I'll tell you the challenge from the property management side of thinking like an owner. And we always want to think like an owner, but if we have 1,500 owners, there are different types of owners. Some owners are like, if the dishwasher is more than 3 years old, I'm not going to mess with repairing it, just replace it. And that's a logical decision because they're going to spend $300 to repair it and they're going to spend $600 to replace it. I'm not going to mess with the $300, just do it right. And we know for 3 more years. And then the other owner's like, I don't care. It could be, there's a possibility that we send out an appliance repair guy and they only charge us $80 and find something. And there's a possibility that the appliance repair guy is $300 into it before he even tells us that there's another $200 left to repair. And we're like, well, in that situation, damned if you do, damned if you don't. So it's hard. We don't know what's
another benefit to being multifamily. If you're doing $200, $300 discussions, but that goes with the management agreement. And I'm sure, probably have, it's like for us, anything over $5,000 is a call to us.
Yeah.
Right. Now we do check our financials. So if we're seeing a bunch of stupid expenses, we're going to make a decision to change course. But meeting with so for us, we have weekly calls on all of our properties. I don't sit on those. That's where the senior portfolio manager, he has all those calls typically on Wednesday, and they go through those type questions, go through if there's anything major. But yeah, if you are having that many customers or clients question, a $300 charge, like that I could not be in that business. I just
the challenge is
it's not even my hourly worth. Like at the end of the day, like at some point, and I say that not to be, but everybody listening to this podcast, like your time is valuable. And if you're stuck in the weeds on a little bit, it's,
you got a question. I mean, we have people that say like, well, there's a repair that's $400 to change, 2 filter grills and add new filters, and we get a response back from an owner that says, I need 3 quotes for this, and here's the Amazon links to the things that, it can't be this much. I'm like, man, it took you a while to draft that email, and there's no HVAC company that's going to go out for, $200 to do 3 hours worth of work all in. It just doesn't work. Like, I'm sorry. I don't know how to explain this to you, but HVAC companies don't make any money on these tiny jobs, and it's going to cost you. So 3 bids are going to come in roughly the same because it's expensive. And you've wasted now a lot of time on your side. You should probably just go do the work.
Go do the work. Well, and it could, and I'm just thinking about out loud here, is like the actual cash flow for that property is probably small. I mean, I don't know. I mean, after they pay their debt, management fee, whatever else, there may be only $100, $200 profit, maybe.
Yeah.
So yeah, that $200, $300, I can get it. Like I can
Sure.
empathize with, like, oh, I'm not going to make.
That's when you have to have a long-term perspective. You got to say, like,
100%.
I hold this real estate for 20 years, and over 20 years, it's going to triple in value. And some months I'm going to make money, and some months I'm not. But every month I'm paying down principal, which is just savings, for savings equity in the property, and it just is what it is.
I agree. But if they think on if they start going on the multifamily side, you're not $100, $200,
Yeah.
So,
it sounds to me like you have delegated a significant amount of responsibility to people that you trust in the organization. I'm just curious, like, what portion of that training do you think came from the military? You did 4 years. Like, what leadership lessons you mentioned? Like, when CBRE was hiring, they wanted people that had, junior leadership experience, and they were able to train them in their vertical or whatever the actual business unit was, but they wanted people that already had the leadership skills. But like, what portion of what you do today or your mindset comes from some of your military experience?
I would say from the Marine Corps, learning that it could always be worse. Like, anytime you're in a situation where it sucks, it could always be worse. So that just shift mindset. I mean, there's so many times where I'm like, oh my gosh, it could always be worse. And it just saying that just like flips me back to like, oh, it's not that bad.
Yeah.
So I think that's good. I think, obviously, I mean, even from my scouting days, like leading teams, and, everybody's got a different want. Not everybody's motivated by the same thing.
Sure.
So like understanding I've got a team member who really never takes time off. Like, we have a very good PTO program at our company, and she doesn't do it, but she's not motivated by the time off. She's motivated by other things. And so that's okay. And whereas I have another team member who takes his time off. So understanding them as an individual of, what they're motivated about, what's their, what their life chapter, whether they're about to get married or wherever, being there, I think you build that culture and that loyalty and that trust pretty fast. Also allowing them to try something, and I don't like the word fail, but like maybe they wouldn't do it the way you would do it, or like it wasn't the right way, like empowering them to doing those things. And that goes back to a little about the entrepreneurship. Like, you have to, if you're micromanaging people, you're not buying back your time.
Yeah.
And
it's hard.
And every time I make a hire, it's buying back my time to focus on growing the company.
Sure.
And there's a book, Buy Back Your Time, or Buy Back Your Time, I think it is, that I read, and we implemented, from our email systems to our meeting, like for me personally. And then I'm in strategic coach. That's another about that, very entrepreneurial coaching and focusing my days. So it's not just the Marine Corps, it's continued learning, reading, going to conferences, joining, different groups, and just taking, like, think about like a toolbox. Like, you're just taking little things here and there, this podcast, taking little things, and over time you've got your tool chest to do what you feels best.
I love that. Buy Back Your Time, Dan Martell. I want to read that.
Yeah. It's a great book.
Good little nugget there.
And Who Not How, Dan Sullivan, like there's so many good ones, but the difference with delegation, so don't expect what you don't inspect. So there's a reason I get a daily KPI report through our system. I always know what our occupancy is, what our collections. We already went through all that. That's not my job to fix. That's my portfolio manager, asset manager. That's what what his job is focused on. But I'm always in tune with what's going on. I'll check in with key stakeholders with my investor relations person, whoever, just to make sure, and other investors, just make sure that they're getting the service. So
Yeah.
when you do delegate it off, it doesn't mean you can't still check in and make sure you got a good pulse of
For sure.
things as well. So
Yeah. Let's go back in the memory bank, maybe not to the Boy Scout days or your Eagle Scout days, but to your first deal. Tell us a little bit about your first deal. Maybe some of the are you out of that deal by now? Are you still
no,
in it?
we're still, yeah, we're in the deal. We bought it in 2022.
Okay.
That deal called Ivy in Houston. I did it more of a text blasting system.
Hmm.
So how I found it was straight up off market. Uh, did the find the recorded owner on the appraisal website.
Hmm.
Went to the Secretary of State to find the true owner. Went to been verified just to see like all these different numbers and just do blast text
Sure.
messages. Right.
Yeah.
I don't know if it's legal or not, but anyway, that's what I did. And so he just texted people. So
It's great.
one guy, he did, I got several text messages back, but one, we just built a relationship. It took about, almost a year of just going back and forth. Um, and yeah, I bought the property off market from him. We turned it around quite a bit. The property was pretty distressed.
How many units was that?
That was 101 units.
Cool. And it was an individual owner, or was that
Yep.
you finally found the GP?
Interesting question, because it was his. Yeah, he was a cardiologist in Los Angeles. He's retired now. He actually has invested a lot into our deals subsequently. And when I go to Los Angeles, I'll have dinner with him. And last time I was with him earlier this year, he's like, I didn't pay anything in taxes. I'm like, that's awesome.
Thank you. Thank you.
Because
Appreciation.
he sees the
for
passive
CREI
income and the
Partners.
depreciation. Yeah. So I'll do a plug for him on that. But anyway, so there's that. And yeah, so at this point, I would say like where the market cycle is in cap rates, it's not for me, it's not the
Yeah.
time to sell. If we can hold on to the property with the debt we have,
What kind of debt did you put on that?
so
Small
initially,
balance.
yeah, so that was a bridge debt, and then we modified that to a fixed rate debt.
Okay. How long was the bridge?
So that was a 3-year bridge loan.
Great.
And then we modified it to a fixed rate year 2. So we were able to work with the lender to get a fixed rate because bridge debt with interest rates, those rates went up. So we worked through that process. And, I think with any real estate too, whether it's single family, multifamily, it's just rolling with the punches of like things are going to come up. And it's
Could be
like,
worse.
don't put your head, it could be worse. Don't put your head on a pillow. Get, what is that next step? And maybe it's, you don't want to look at it from like a mile away, like, oh man, that's far, but it's like one step for the other.
Yeah.
But it's doing good. We'll eventually sell that property and, part of the cycle. But in today's environment, I wouldn't sell anything.
What's the nature? So you were able to put permanent financing on it in year 2.
Yep. So 6%. We've got a 6% fixed rate interest only on that.
And what was the extent of the renovation that you did? And how much were you able to kind of bump rents on the back of that?
Yeah.
renovation?
So yeah, on that one, so we went in, bought it when all the roofs were leaking. The HVACs were in horrible shape. I mean,
that's what I would expect from a cardiologist living in LA that owns a 101 unit property.
I mean, but he had owned it for a long time and, he just he cash flowed it. I mean, it was just like sucking money and he didn't put any money back. So it's what he did, but that's all right. Different investors do different things.
Sure.
But we went in, we did new HVACs, new roofs, new paint, put in the we did carport, we did the carports, resurfaced the pool, and we did a lot of work to the property. Average rents at that time were about $925.
Okay.
We bumped that to about $1050. So we saw $125 bump there. And then for the 2 bedrooms, if I recall, they were probably a low 1,000, like maybe 1,025. We got those to like 1,300.
Great.
So that was sort of the peak things were going, and then the market softened, right? And so rents in Houston and in many areas, rents have softened, and so we've seen a decline, and that's what really pushed us to like have those conversations with the lender of like, hey, let's modify this loan, get through it.
Yeah.
But when you work through that type, you fight your taxes. Luckily, insurance has been going down, repairs and
Wow,
maintenance.
insurance in Houston's been going down, huh?
It has, yeah, because it's all about capacity. It's about the amount of carriers that are
Sure.
willing to
We'll
take on that
take that
risk.
risk. Yeah.
So there's been a more supply uh, of that insurance capacity in the market. So we've been seeing some different things going in our favor. We've been starting to push rents. I mean, we've been hovering around 87 and 90% occupancy. So, and I'd say that's, we can push a little further and we will, but when you're competing with other apartments, it's the cycle that we're in.
Yeah.
And so, um,
What part of Houston is that in?
that's in the Galleria submarket.
Oh, wow.
Yeah. So
Beautiful.
it's a good submarket.
Yeah.
Location, property looks amazing. But that was the first one. Now the first one syndicated. Now I've done, did
Sure.
my single family prior. And then after that, we did our development in Lafayette. And, that one is going really well with the development. Louisiana, I've learned just it takes a little longer to get things done. Like it's just Louisiana
You don't
time.
say.
They tell you it's going to be, this day, just add a couple weeks. So,
Yeah.
I've learned that, which is fine. Every little market's a little different. But yeah, that was the first, but the biggest thing on that one is like a lot of people go where there's other sharks going after the same meat. Right. And so that's what spikes these properties. So when a deal goes on the market, we, as in myself, I do not buy. So brokers come to me before it goes on the market, before even an offering memorandum really is developed.
Yeah.
We buy off market.
Yeah.
And it's important because if you go the what I call blue ocean route, and that's like finding off market opportunities direct to seller, or / going to broker and building relationships where they come to you when they have an opportunity instead of going to the whole, world. Those is where you really make your cash flow. When you start buying on market, like if you have that sign in your lawn or like there's in the commercial world, if there's an offering memorandum, to me, you're just the highest bidder.
Yeah. And just for explanation, offering memorandum is a bunch of beautiful photos of the property as it is, maybe some renderings of what it could be, some architectural drawings of what it could be if you wanted to go and actually do the work to develop it, that trailing 12 cash flow with some unrealistic expectation of the future 12 months, where insurance costs are going down and the roof replacement is,
taxes are still on the, prior valuation and not the new value. Yeah.
And you can come and buy this property and hit a home run. So yeah, you're right. Before all the beauty's going into it, into making the presentation, if you can get it off market, it's a beautiful potential opportunity. I want to ask, on the fourth Monday of every month, you do a virtual meetup where people come together and they learn. And your primary passion, I mean, you're obviously an entrepreneur, a business owner, but one of your primary passions is education, just letting people kind of dive deep into your brain to learn something and hopefully make fewer mistakes than you have in your career so that they can avoid some of the pain. Tell us about that meetup on the fourth Monday of every month. How does it happen? How does somebody get on your list so they can join that? What do you discuss?
Yeah, so I started this a few years ago. It's the Texas Multifamily Passive and Active Investors Meetup. If someone put in Texas Multifamily Meetup, my meetup would probably be one of the first, if not the first. Every month, the fourth Monday of every month, it's virtual. So no matter where you are, dial in or, join our email list and you'll get it as a recording. But we bring in other we bring tax lawyers, talk through syndications, talk through, cost segregation. This month, I'm talking about what passive investors should know about underwriting, because there's all these different levers within underwriting to make a deal look better than what it really is. And so we'll pull up one of our deals and we'll go through, underwriting and hey, if I did a cap rate here or a cap rate there or rent, just try to go through it. It's more just asking, it's not making it like there's a black curtain and you don't know what's going on behind the scenes.
Yep.
And so that's what the meetup is. And then I have a passive investor coaching program. It's passiveinvestorcoaching.com. And it's free. It's over 5 hours of small videos to go in and just learn about how to look at a deal, how to analyze. So the education platform is for me important because I have spoken to several people who didn't ask the right questions, didn't know what they're doing, and their investment got in hot water, and you can avoid that just through some education.
Sure. If I understand that there are levers, you say, I'm buying this thing at a 10 cap and I'm going to exit in 5 years at a 5 cap versus a 6 cap. There's a significant differential in the ultimate IRR at exit. Why does a syndicator though want to paint a rosier picture only to underdeliver at the end result? And I guess one answer that I have is because they want to do 5 deals in the next 5 years before anybody ever realizes that their underwriting criteria are bad. But there must be other reasons that people want to. I would think, if anything, you want to over deliver and under promise, said vice versa, and say, look, I'm going to exit at a 6 and then ultimately exit at a 5 because the market conditions are favorable and you look great, like a hero, and people's expectations were gladly met and exceeded. But why would somebody play with the levers in a way that makes the deal look better and then under deliver?
I think it's more it looks flashier so they can raise capital easier. I don't know. There were so many 2021, 2022. It was crazy what people were buying real estate for.
Yeah.
And making these numbers work. And the only way to do it, I guess, is to be really aggressive on some of these levers.
Yeah.
And so fortunately for us, like, we didn't do that, and we're not losing our seats, or, we're able to like be at the table playing real estate right now because we were conservative. So I feel grateful in that discipline and what we did there. But with cap rates, no one knows where cap rates are going to be in 5 years. Like for
Sure.
us, in Houston, San Antonio, cap rate could be around 6.5. But if you look at like CoStar's report, cap rates in 5 years could be 5.75. That's so the idea is that as rates decrease, even though we're tied to the treasuries, there's going to be more money and capital being flown into real estate,
Sure.
which would reduce cap rates. So I think
Just sounds like short term.
how I get away with it, Matt, is like I show like a sensitivity analysis because I don't know exactly where we're going to be in 5 years.
So this is what the outcome is.
What if the cap rate's at 6 or 5.75 or 7?
Yeah.
And so when we do a webinar, we present as like, okay, this is our base case. This is what we feel like it is. But then we have a slide dedicated to a sensitivity analysis of showing other returns if we don't get a 3% rent bump. Maybe it's a 2%. So it shows different ways. And then it's up to the investor to be like, okay, I'm comfortable with a 12% IRR versus a 15 that Wayne thinks it's going to be. But because he's shown a sensitivity analysis, I can get behind a 12 IRR. So that's where, it just, everyone's going to have their different opinion on the stuff. But that's what I really want to do, like this, when we go back to this meetup conversations, like, this is the rent roll. This is a T12. Like, what is a T12? It's the trailing 12 months of income and expenses.
Yeah.
So that's the stuff like I want to share with passive investors so that they can ask those questions and, maybe dig in a little bit more on verifying or validating, like, okay, I feel good about this business plan.
Yeah. Besides, last question, shameless plug. Besides thinking like an owner, what are the most important things that a property management company can do to bolster your value to investors?
Pick up the trash.
And
I
think like an owner.
And I'm not even kidding. I mean, I'll go, okay, I went to a property in San Antonio. I was walking, doing a property visit. I see trash, I pick it up.
Yeah.
And then I'm going along, pick it up. I'm like, property manager, I won't say his name. I'm like,
pick up the trash.
If you're not doing the little stuff, you're not doing big stuff.
Yeah.
Right? If you're overlooking, and so my thing is like, especially when an owner's there, like, take care of the asset. Like, if you see trash or whatever, and what that is going to do, and I'm being a little assy-goosey on this, because it's like the trash symbolizes the overall picture. Like, if you don't have the attention to detail, take care of the asset when the owner's there, then what do the financials look like? What are the relationships? What are the community events? I mean, for us, I think it's really hard for a property manager to think like an owner. And this is why I didn't ever do residential property management. I would have a really hard time because you're dealing with people's personal lives.
Yeah.
Whereas when I did office and retail, it was very business. It was business. It wasn't personal. It's not your home.
Yeah.
So it's that balance of like, okay, you have a fiduciary responsibility to the owner, but then you're dealing with other people's stories of why they can't pay rent or whatever their stuff is going on. And so I do understand, like, it's hard to take care of your customer or resident and the owner. But ultimately you work for the owner. And if, and for me, like, we empower our managers to make good decisions as far as taking care of a resident. But it's really hard to find somebody who just as simple as pick up the trash. I mean, not you do much more as part of management, accounting and everything else. I don't want to undermine the whole work, but at the end of the day,
pick up the trash.
Take care of the small stuff.
It's emblematic of the big picture. Just pick up the trash.
Thank you. Yes, that's what I'm trying to say.
I like it. Wayne Courreges is the founder and lead sponsor of CREI Partners, which manages over $60 million in commercial real estate assets across Texas, Louisiana, and Alabama. He helps busy professionals build generational wealth through passive investments in apartment communities and storage developments. We've already talked about it. He's a former Marine Corporal. He was an Eagle Scout, and Wayne brings over 16 years of experience from a Fortune 125 real estate firm and now focuses full-time on creating high-yield returns while giving back to local communities. Visit his website, CREIPartners.com, or dial it back a few minutes and let's talk about the fourth Monday of the month meetup that he does. Wayne, thank you so much for being on the show. We really appreciate it.
I appreciate you, Matt.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.